Lynn Alden, an accomplished macroeconomist and investment strategist, delves into the intricacies of articulating the imminent financial challenges to friends and family. She highlights the need to reevaluate governance in a digital era to curtail excessive government control. The traditional system of checks and balances in the United States has faltered, with legislative matters increasingly handled by federal agencies rather than Congress. These agencies often operate without adequate accountability to the American populace. Alden draws a link between the financial system's breakdown and the surge in government control. She underscores the bewildering complexity and opacity of the monetary system, which fosters political polarization and diverts attention away from pressing concerns. Both political entities and powerful corporate interests may have an incentive to distract public focus from the intricacies of the monetary system, allowing corporate interests to wield disproportionate influence over governmental decisions.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
One way I'd phrase it right now is that we're kind of seeing the failure of incrementalism. So a lot of people, the way they engage politics, they think if we just get like our person in charge, we can start turning this around. And then that person, either well-intentioned or not, gets eaten by the machine. And the machine just keeps going. And then people say, well, if we only get the next person in charge, we can turn this around. And so all these kind of like small measures are just going against basically the Borg of the bureaucracy of the system of as things are designed. And historically, you tend to see kind of like things go on and on and on and on, and then a gigantic trend change. And that's when it really matters what the culture of the society is, because that's when you can get either very virtuous outcomes or horrific outcomes. And the way I would describe it is that when you look at, like, I approach financial systems in the way that I approach systems engineering, like as though I'm analyzing a complex system, because that's what we're doing. And there's stable systems and unstable systems, or marginally stable systems. And the financial system has all of the traits of an unstable system, in the sense that for decades and decades, you have rising debt percentage of GDP, falling interest rates, which allows you to pay for those rising debts, even though you're getting rising debts. Basically, the interest expense is not rising. And then when you have a gigantic debt bubble, when you hit zero rates and you start going sideways to up in interest rates while you still have that very large public debt burden, that's when a lot of the things that keep getting there, you kick the can down the road over and over again, that's when it starts to materialize in the present. And that's when we look around and we wonder, like, why is none of this working anymore? Why is this, why is this getting increasingly bad? It's because we've kind of extended the system as far as it can go.
Out of bullets.
Yeah, we're out of bullets. And now we're kind of dealing with the consequences of a system that always, for the past, say, 4+ decades or more, was always unstable. But that could be delayed, deferred, pushed onto someone else, often in the developing world, kind of push that. But now a lot of these things are starting to hit in the present.
So we're there right now.
Yeah, I think we've been there really since the global financial crisis. I think this is a multi-step process. That's one thing I cover in my work, is that basically these things historically, at least with the data we have and logically, tend to go in two phases. You have kind of the private debt bubble blows up, and then the response almost inevitably, not every time, but almost inevitably, is to push that onto the public level. So you bail out the system, you bring all that debt or a lot of the debt onto the public level, some part of the private sector deleverage, and then the public debt part keeps building, and then the second hit is when the public debt bubble starts to have a problem. And I think that's the phase that we're in now. And that's still a multi-year process playing out. I would say one is that the more connected the world is, the more it's going to be a worldwide issue versus local issues. People that have seen the podcast before probably know that I often compare the 2010s to the 1930s and the 2020s to the 1940s. So there are a lot of elements back then. What's new this time is that most of these kind of long-term debt cycle or institutional cleansing cycle things that we go through, fourth turning, whatever you want to call it, usually there's a changeover in the type of money we use. You go from, say, free banking to central banking with a gold underlay. Then you go to another central banking model where you don't even have a gold underlay anymore. And what we've never done before is go through one of these cycles when we were fiat currency going into it. So what comes out, right? We've never gone in this gigantic fiat currency global cycle, have a whole sovereign debt crisis on a global scale, and then see what's on the other side of that. That's new.
The U.S. government's total debt has surged dramatically, as revealed by the Treasury's fiscal data platform. In just 7 days, ending on October 18th, an astounding $16.12 billion has been added to America's debt load. Crossing the $33 trillion milestone on September 15th, The total outstanding U.S. debt now reaches $33.62 trillion, marking an increase of approximately $17.71 billion per day. In a recent interview with Bloomberg TV, Greg Fleming, the CEO of Rockefeller Capital, expressed his apprehension about the mounting debt burden and the potential consequences of America's interest payments on economic growth. Let's now turn our attention to Lyn Alden's perspective on the surging U.S. debt, the ongoing inflation, and the recurring debates surrounding the prospect of a recession.
Not even just hyperinflation that can do it, it's the perception of the loss of control.
Right.
And so, for example, there are a lot of developing countries today where they're not in, say, outright hyperinflation.
Yeah.
They might just have double-digit inflation on a recurring, regular basis. It's like a background part of life. And there's no expectation that they're going to get it under control. And that's kind of the world. That's historically a developing market phenomenon. And you can get that kind of situation in the developed world if this is left unchecked. I think that's kind of on the train we're going for, is that you can call for kind of a central bank losing control in the sense that there becomes no clear way where they can get it back down to their kind of prior baseline of money supply growth and price level changes and things like that, where there's too much public debt for them to tighten the way they want to. And then the challenge is that when you have a lot of public debt, interest rates start losing their effect. They become more complicated tools to try to slow down inflation compared to when you have lower public debt levels and higher private debt levels. And so when I get questions on hyperinflation stuff, I kind of put that aside and I say, we don't have to be there for this to be a problem. Like if you look at right now, the market still generally thinks the Fed can get the current situation under control. And maybe for a few years they can, right? It's, you can cyclically get it under control potentially. So right now, whenever you see kind of a higher inflation print than expected, you'll see the dollar strengthen, and you'll see other, because they say, well, now the Fed's got to get even tighter, right? Because they're going to get this, right? And so that's the current kind of market reaction for how this is going. And when you go through the looking glass is when the market realizes they actually don't have control. Right. And we're not there yet, but I think we're on this kind of either multi-month or probably more realistically multi-year process of getting to that point. Within the 2020s, I think. Next few years, perhaps, I think that what I look for is the ingredients that can lead to that. And I then judge the probability that those ingredients are building. So one would be energy security.
Yeah.
That's obviously in a dangerous spot right now. And sometimes the problem goes away, but the structural issue's still there. So one would be energy security. And then the other one would be looking at the size of deficits, wondering how they're going to be financed, looking for any attempts to kind of improve the deficits, and then looking at the overall public debt to GDP ratios, because that's an indicator.
135%.
Exactly.
I'll never forget that.
Yeah. And that's an indicator that starts to become relevant, because when you get to that very high level and you raise rates, at the same time as you're pushing down the private sector by raising those rates, you're also greatly increasing the deficits. And so if you imagine two numbers, if you imagine the US in the 1970s, the US had 30% debt to GDP, and most of the money creation was happening in the private sector, not all of it, but a lot of it. And when Volcker raised rates very high in that period, it did two things. One, it slowed down bank lending, because now it's a much higher hurdle rate to borrow, but it also would increase the deficit to some extent, because you're paying higher interest on your debt. But because that was so small, the negative impact on the private sector was much larger, meaning that those rate hikes were disinflationary. The problem is, if you fast forward, let's even go past the current, let's go to Japan. If you have 250% debt to GDP and you have pretty slow bank lending, almost all the money creation is really coming from the government deficits, the monetization of those deficits. And so if you raise rates, you actually risk accelerating money supply growth, because when you raise rates, the public interest expense will balloon significantly, because you're doing it from a 250% debt to GDP base, whereas you're not going to impact private sector lending much, because that's already small relative to that. So that's the problem, is that as you get more and more debt on the public level, interest rates become a more mixed tool for addressing inflation, and eventually can become literally a negative tool for dealing with it.
On Thursday, October 19th, Federal Reserve Chair Jerome Powell expressed his concerns about the persistent high levels of inflation in the United States. He indicated that bringing inflation down to the Fed's 2% target would likely require a slower-growing economy and job market, pushing back against market expectations that rate hikes had concluded. Powell emphasized the Fed's vigilance regarding economic data and labor market dynamics, noting that any signs of continued above-trend growth or a tightening labor market could jeopardize progress on inflation and warrant further monetary policy tightening. Chair Powell also underscored the uncertain path ahead, with the journey to reach the 2% inflation target expected to be challenging and time-consuming. He affirmed the Fed's resolute commitment to achieving sustainable 2% inflation. In the face of evolving developments, including geopolitical risks, Powell emphasized the need to strike a balance between preventing inflation resurgence and avoiding excessive economic strain. Your thoughts on Lyn Alden's insights into these topics are welcome. Please share your opinions in the comments section below. For more daily dose crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.